So cash or what? So what do we do with our cash? As the question has come up many times, and I think many of you are thinking with the issues with the bank, how safe is my cash? And if I don't want to do cash, what's the cash-like alternative? So I'm going to give you some examples of what to look for and why, and something to think about on this episode of Clearview Finance. Let me begin by this. Cash, we all know that it's an extremely safe investment, or is it? I mean, that's become questioned now with what's going on with the banks, and many of us have been deciding, hey, what do I do with my cash? Well, let's be straight. Cash is cash. Cash is always king. But I know that when we have extra amount of money and we have money in the banks, we want to make sure that do I have to have cash, or what are my alternatives, especially today? And again, as this question has arose, I want everybody to understand the risks or the actual what happens if you choose to go outside of cash in a cash-like alternative. I want to give you some examples and some things to think about. But for starters, let's be clear with cash. As long as we are under the $250,000 limit, we are covered by the Federal Deposit Insurance Corporation, or FDIC insurance. So again, keep in mind the positivity behind that. So again, we don't need to run and panic. But when we talk yield, and everybody knows how some banks are taking advantage currently right now of still paying what we call a sticky customer, somebody that's been at the bank a long time and leaving it there and is comfortable with cash. We realize that regular CD rates and maybe some savings rates aren't up to what some other alternative investments or alternative cash alternatives are, of why that might be something that we are starting now to look, because we're starting to say, hey, look, if I can get safe yield money over 4%, why am I not doing it? But always remember, there's some risks involved in order to do that. But my key thing that I always want to tell everybody is, what is the cash meant for? Cash is cash. Is it our emergency fund? Is it cash that we might need in short term, like 6 months? And again, that concept really makes a difference, because we don't want to be looking at investments as for cash, meaning if our investment plan is doing what it's doing, we don't want to sell that because we think maybe we're getting 4 or 5% initially, and maybe one of these cash or cash alternatives. Remember, we have to stick to a long-term investment plan if that's what our goal is. We have to be long-term investors. So when I look at cash and cash alternatives, I want us to be very clear. They're there for specificity, and they're there for emergency, short-term fund, and if we want to have enough cash on hand, that is not part of our financial plan. So in our planning process, it's very key to always remember where we're having cash and what the purpose of cash is. Okay, so let's make sure we got that straight. So let's talk again though, what are alternatives that we have? I mean, we hear certificates of deposit. Again, the banks are putting those out, but we have what we hear teaser rates. And always remember when we say this, to get a teaser rate, for an example, we have a local bank here that's giving a 14-month CD that's paying over 5%. Okay, that's fine, but what was the key that I just said? One is I said 14 months. So always remember, there's going to be time frames put on your money to get a yield. So in order for us to earn that 5%, we have to keep it in that bank CD for 14 months. So yes, as long as we stay under 250,000, that is FDIC insured, and now I have an opportunity for a certificate deposit for 14 months or whatever that is. But remember, the key is you have to know time frame in order to get the yield. So that's different than having a cash and a savings account that I could go get today. So remember, we got to continue to separate our needs for that money and what the intention of that money is. You hear me say all the time, we have to be intentional. That's meant to be intentional. Okay, number two, high yield savings accounts. We see these all the time. And so these where banks now are starting to say, look, especially these online banks are offering a little bit better rates than what we would say as brick and mortar banks. How come? Because they don't have as large of overhead. So now you're starting to see high yield savings accounts, and everybody's saying, oh, that's great, 3.75, 4%, certainly better than what some normal checking accounts are paying. So great, we're like, hey, why wouldn't I do that? And you may be right, that may be a perfect short-term parking spot, but always keep in mind this. When they're giving you the interest rate, those change. If it's a 7-day yield, those are gonna change every week. They could be changing every month. So those rates are variable. Those are not fixed rates, and they move just like the rest of the interest rates do. So they're extremely interest rate sensitive. So keep that in mind. Your time frame is important when it comes to looking at cash and cash alternatives. Okay, so now we heard the big buzz, money market funds. Everybody's now, as you can read the news, are taking deposits out of banks and they're running to retail money market funds. What is a money market fund? A money market fund is simply an instrument to earn a better yield. They're commercial paper, they could be government bonds, they could be CDs, whatever the company chooses. But let me be very clear about something, and if you have to read a money market, please read it closely. Read the disclosures. Money markets, despite paying a much higher interest rate right now, again, they change very often. Those interest rates are variable. They will change. But read tight, because what some of that means is the investment can lose value. Back in 2008, we had prime money funds that actually did something. Money market funds are worth $1. The key is that they never go below $1. Means our investment is safe. Back in 2008 financial crisis, it was called breaking the buck. It was one of the first times in history that money market accounts prime money market accounts went upside down under $1, which means there was risk involved. So money market accounts, despite attractive returns, please understand what you're getting into. For that return, you are taking some risk. If they are through a retail mutual fund or something of that instance, they are not FDIC insured. So again, once we remove money from a bank, remember what we're doing. We are taking some risk for that yield. So we want to pay very close attention to that. You also hear things like treasuries. What's a treasury? Well, it's a United States Treasury. It's a bond backed by the government. And the key, when we say government, everybody thinks safe. And the truth is, yes, they are safe. But you have to pay attention to what we call duration and maturity risk. And that means what type of treasury bond or short-term bond or bond am I buying? It means if I buy a 1 to 3 month bond, it means I have to hold it for 1 to 3 months. If I buy a 1 year or a 2 year treasury, I have to hold it for 2 years in order to make sure that I get my principal back. So right now, again, depending on the length of the duration, 7 years, 10 years, 20 years, those are going to mean that you have to hold that for that period of time. If I choose to liquidate those before their maturity, I have principal risk. And the reason that is because as interest rates rise, your bond price goes down. So if I sell early, I could be forced to get out of my investment less than what I put in. So again, this is chasing yield, but it's giving you some risk. What's the risk? If I don't hold it to maturity. So keep that in mind, very important. But if we hold them, they don't lose value. And that's, again, something safety, but we have to pay attention as our financial plan, our goal. What are we doing? Can I afford to have my money tied up for 2 years or 1 to 3 months? And again, that matters. You need to do your homework on that. And last, I would say you hear about short-term and ultra duration mutual funds. So these are investments that will do some of the investment for you. But again, we're coming back. They have rose to popularity right now. They're paying what we call very good yields at this point, but let's keep something in mind. They are mutual funds. That means that more than likely they're not held to the same duration as if you bought the bond itself, just like we talked about buying that 2-year treasury bond means I held it for 2 years. If I own some of these short-term duration mutual funds, they are usually traded. So it means that they're not really allowing you to guarantee your principal. So there is some risk involved for chasing yields. So always keep in mind here when we are pushing for yield and I'm going outside of a cash type like investment, we're going to take some risk. So always make sure you keep that in mind and what the intention of that cash money is for, because I'm a big believer in cash is cash, cash is king. And if we try to chase more yield, we got to be willing to take the risk. So be careful. So thank you. That's this week's Clearview Finance.